All right, guys. Want to do a quick Zoom for you guys today. We are joined with Eric Oliver, who is in the cost segregation studies industry, and super excited to have him present today for us. Eric, looks like you hold a bachelor's of applied science and accounting from Westminster College. So there we go, Utah-based school. And what I like about Eric is I found him teaching cost segregation studies to other people. So he's very good at teaching his craft and helping people save taxes, which is good. But I also like how you educate not only your clients that are doing cost segregation studies, but also the CPA industry as well. So we're very lucky to have you on today's Zoom call. And then I'll let you kind of go from here.
All right, sounds good. Thanks, Bryan, for having me. Glad to be here. Glad to talk about cost segregation. Just to get started, we will talk about kind of what cost segregation is. I know a lot of the listeners have probably heard that term, maybe aren't familiar with what exactly it is. So we'll talk about what cost segregation is, then jump into some case studies to kind of show how it's applied in real world case studies. And then if we've got time, we'll talk a little bit about the IRS audit guide. That's probably the most exciting part for me, probably the least exciting for your listeners, but it's important to understand how the IRS looks at these and make sure we're in compliance in that stance. So with that being said, we get asked quite often, what is cost segregation? And really all it is accelerated depreciation on your real estate holdings. So one of the benefits of owning real estate is that we get to take a non-cash depreciation expense every year against our ordinary income. So normally commercial properties are depreciated over 39 years. Residential properties are depreciated over 27 and a half. So to put that in layman's terms, if you've got a $390,000 office space, let's say, essentially you're going to get a $10,000 write-off every year against your ordinary income. So instead of, let's say I make $100,000 a year, instead of paying tax on $100,000, I've got this $10,000 depreciation expense. I'm now only going to be taxed on $90,000. So that's how the tax savings is created. Well, what if my investment strategy might not be to hold the property for 39 years? Hell, I might not even be alive in 39 years the way I eat, right? According to my wife. So give me my deductions now versus in the future. And the way that we do that is through an engineering-based study where we come in and identify short-term assets. So in that same example where I purchase an office building for $390,000, I'm not just buying the land and the walls, I'm also buying some carpet. I'm buying a parking lot. I'm buying some window coverings, some cabinets, some appliances. All these different assets, according to the IRS, should be depreciated over a shorter period of time. And so a cost segregation study comes in, identifies those assets, puts a value to those assets, and then provides you and your CPA a revised depreciation schedule that allows your CPA to depreciate, for example, the carpet over 5 years versus 39 years.
Yeah, which makes a lot of sense to me because carpet doesn't last very long.
No, it certainly doesn't last 39 years. So the whole idea is if we can front load this depreciation, it creates a bigger write-off in the early years. And there's a number of reasons why you would want to do that. You've got inflation, you've got time value of money, you've got to pay down some existing debt, maybe go invest in new properties, but it creates cash flow by reducing our tax liability. Therefore, we're sending less money to the IRS and keeping more of that money in our pocket. So that's really kind of the groundwork of what cost segregation is. Now, how do we identify what in a building can be depreciated over a faster period of time? So there's really three tests we look at. One is if the property can be removed without damage to the building or structure. And so again, we'll use carpet as an example throughout this presentation, but if I were to take the carpet up out of this office that I'm in, hopefully the walls are not going to collapse, right? Carpet can be easily removed, and carpet certainly doesn't last 39 or 27 and a half years. So it's probably personal property. The second being if the relationship between the asset and the equipment or machinery is so close they'd be retired at the same time. So an example of this would be I'm here in an office. I've got a TV on the wall here. Behind that TV is a 5-year asset. But behind the TV, I've got an electrical outlet that's specific for that TV. The only reason I've got an an outlet on the middle of the wall is specific for that TV. Well, not only do I get to depreciate that TV over 5 years, but because that electrical outlet is specific for that 5-year asset, I now get to depreciate that electrical work all the way back to the circuit breaker as a 5-year asset as well. So you start to think, Bryan, about an apartment building. How much of the electrical work in an apartment building is specific for short-term assets? Things like garbage disposal, ceiling fans, appliances. Sometimes it can be as much as 50%. And so being able to not only allocate the appliances to a 5-year asset, but also portions of that electrical work can generate some significant tax savings. And then the third is the relationship between the asset and the nature of the business are unique. I'll give you an example of that. I don't know. Have you heard of, or do you know what mead is, or a meadery that produces mead?
I don't.
That's all right. I didn't either at the time. So we got called to do a cost segregation study on a meadery that produces mead, and mead is just fermented honey. So they take honey, they ferment it, make an alcoholic beverage. And this meadery was in Phoenix, Arizona. So you can imagine Arizona, it's 120 degrees down there in the summertime. And so they had this warehouse with these 50-gallon drums of honey, and they had specialty cooling equipment to keep this honey at a certain temperature. Well, normally cooling equipment, or HVAC, is not considered personal property. It's part of the building. But in this specific instance, that HVAC was specific for that honey and keeping that honey cool. We were able to reclassify that as equipment and accelerate the depreciation on that significantly faster. So that kind of gives you some of the rules on how we identify short-term assets. This next slide here, Bryan, is a list of short-term assets. So over there on the right-hand side, you have your 5- and 7-year assets, things like carpet, countertops, cabinetry, blinds, window coverings, portions of the lighting, portions of the plumbing, window treatments, wall coverings, and removable flooring. Then in the 15-year category, in the middle, we've got all of our land improvements. That's all of our exterior improvements. So things like parking lots, curbs, gutters, asphalt, storm drains, irrigation systems. Trees, bushes, and shrubs is kind of an interesting one. We'll actually go out around the office building here, count all the trees, bushes, and shrubs, put a value to those, because the IRS says those are a 15-year asset, not a 39-year asset. So everything that's left over, which is typically somewhere around 70%, is considered real property. That's your stuff on the left, your steel structure, your roof, walls, doors, windows, HVAC, etc. So typically when we do a study, Bryan, we're segregating somewhere around 30% into shorter asset lives of the building's value.
So it sounds like you actually go to the property and not just hop on a do-it-yourself software and do the study, right? Like you're actually going and doing your due diligence.
No, we absolutely do. So the IRS, it's interesting, the IRS specifically states in their audit guide, which we'll talk about here at the end if we've got time, that you need to do a site visit in order for it to be considered a quality study. So we'll do that site visit either virtually through a video conferencing app, or we'll do it in person where we send out one of our costing engineers to go out and look at the property. So yeah, that's a great point. Some of the additional benefits, Bryan, of doing a cost segregation study, we'll go through each of these individually, but one is called bonus depreciation, which really puts our deductions on steroids, essentially. It allows you to accelerate even faster. We'll talk about how that works and when that applies. Then you've got something called catch-up depreciation. That's when you've owned a building for 5 years, never did a cost seg study. You have a tax liability this year. It allows you to go back and do a cost seg study on that existing building and move all those deductions forward into the current year without ever having to amend a prior year's return, which is great. Then we'll talk about the reduction of recapture on sale. Probably the most common question we get is, hey, Eric, if I'm taking all this deduction up front, don't I have to pay some of it back when I sell the asset in the form of recapture? And we'll talk about why that is not the case. And you can actually create a permanent tax savings upon sale as well. And then the last thing, if we've got time, we'll just touch quickly on something called partial asset dispositions. All right, so let's first look at a case study here. This is a bike shop. It's called the Bike Peddler. It was new construction, built for $1.3 million, put into service in 2022. Tax year is 2022. We went in, we identified all the short-term assets, all the personal property. Believe it or not, these are actual pictures from that bike shop. I know they don't look like it. There's a medical chair. At the end of that bike shop, there's actually a medical suite there. But we went in, identified the different assets of the building. And here's what we came up with. So over on the left-hand side of this blue section here, you'll see we've got depreciation without cost segregation. And I'm going to see if I can, this is usually where the presentation goes south when I start using the writing tool here, but let me see if I can do this without screwing this up. So over here on the left-hand side, oh no, that's not going to work. Oops, hold on. We'll go back. All right, so here we go. So over here, on the left-hand side, this is your depreciation without cost segregation. So if you don't do cost segregation, we're going to take that 1.325, divide it up over 39 years, and you're going to get a $33,000 write-off every year going forward, which great. That's a great reason to get into real estate. Anyone could use a $33,000 deduction. With cost segregation, that's the green section here. Across the bottom, you'll see we still have $1.3 million of building, but now we've segregated that into $145,000 worth of 5-year assets, $13,000 worth of 7-year assets, and $251,000 worth of 15-year assets. The rest of it remains, in this case, about 69%, remains in that long-term 39-year category. But that $145,000 worth of 5-year assets, we now get to depreciate that over 5 years versus 39 years. Our 7-year assets over 7 years, our 15-year assets over 15 years. And over here on the right-hand side, this is our new depreciation amounts going forward. So in year one, we only own the building for a partial year. So instead of getting a $16,000 write-off, we got a $55,000 write-off.
That's one of the coolest things. It looks like you can speed up or slow down depreciation then.
Right. That's all we've done. And so in year two, instead of getting a $33,000 write-off, we're now getting a $97,000 write-off. And that's simply because we've segregated these 5, 7, and 15-year assets and front-loaded these depreciation amounts in the first 5 years, first 7 years, or first 15 years. And so it's not until year 2037 down here that you're actually getting slightly less. You're getting $3,118 less than you would have had you not done cost seg. That's fine. I may not even own my building in 3037, right? Or even if I do get slightly less, I've already paid down debt. I've reinvested it. It's created a tax savings and cash flow that I've been able to do something with that money.
That's
so
what
you can
talking
see
about
here,
time value of money, right? Being able to
right? Time value of money, inflation. Absolutely, you got it. So you can see here in this example, we had a 15 by increasing depreciation in the first year by 38,000 at a 35% tax bracket, that creates a $15,000 tax savings. That's just in year one. Over the first 5 years, we create a $68,000 tax savings when you add it all together. So pretty straightforward, basic cost segregation. Just wanted to share that example with you.
Yeah, that's awesome. Being able to see a visual, how it's breaking down on the depreciation each year makes a lot more sense than just saying, hey, you might only get 30% year one, but now you're seeing all the details.
Right. Absolutely.
So question for you, why is
Yeah.
7 year so low at 1%?
So 7 year is a category we don't typically find a lot of 7-year assets. So 7 year is kind of your telecommunication or cable lines. And so not all properties have 7-year property. And if they do, the number is usually pretty small.
Gotcha.
All right, let's go ahead and move on here. So let's talk a minute about bonus depreciation. I mentioned that a minute ago, but bonus depreciation, the government utilizes bonus depreciation to stimulate the economy. So in the past, if the economy's not doing well, they'll say, hey, we're going to give you guys bonus depreciation if you go out and buy stuff. And you got to, and they tell you what you have to buy. It has to have a useful life of 20 years or less. And at the time, it had to be brand new. You couldn't go buy a used bulldozer. It had to be a brand new bulldozer. And if you bought a brand new bulldozer back in 2017, when bonus was 50%, you got to take 50% of your deduction. So if you buy $1 million bulldozer, you would get a $500,000 write-off in year one, or 50% bonus in year one. The other 50% plays out over the useful life of that asset. Well, people will ask, well, how does bonus apply to real estate? Because real estate, number one, has a useful life of 27 and a half or 39 years. Well, that's true unless you do cost segregation and you segregate 5, 7, and 15-year assets out of that building. They now have a useful life of 20 years or less. So prior to the Tax Cuts and Jobs Act, that was the Donald Trump overhaul of the tax code back in 2017. The bonus percentage was 50%, and it was brand new, meaning you had to build a brand new apartment complex. And anything we identified as a 5, 7, or 15-year asset, you got to take 50% bonus on, which was great. Well, with the Tax Cuts and Jobs Act of 2017, 2018, a couple things changed. Two really important things changed. One is they added a few words to the tax code. It no longer had to be brand new equipment. It had to be brand new to you, the taxpayer. So that just by adding to you, the taxpayer, like 5 words, it changed the whole outcome of that provision. That's the first thing. Number two is they changed it from 50% to 100%. So now any properties placed in service, and you can see down here the table, any properties placed in service between 9/27 of 17 and 12/31 of 2022 are now eligible for 100% bonus. And remember, it only has to be new to me, the investor. So I can go buy a building that was built in 1970, an apartment complex, have a cost segregation study done. So let's say I pay $1 million for the apartment complex, have a cost segregation study done where they segregate around 30% of that. So 300,000 of that gets reclassified into short-term assets. That 300,000, I now get 100% of that all in the first year, which is just, it's amazing. It's huge. We're creating deductions now that people can't even utilize. You'll see here in 2023, it starts to phase out to 80%. 2024, it goes to 60% and so on until 2027 when it's down to 0. But let's look at that same bike shop, but now let's apply the bonus depreciation. So you'll recognize these numbers. These are the same numbers. We've got our $33,000 of depreciation over here every year if we don't do cost seg. Down across the bottom, we have our same numbers, $145,000 worth of 5-year assets, $13,000 worth of 7, $250,000 worth of 15-year. But if you recall, Brian, in that last slide, this $145,000 was spread out over 5 years.
Yep.
This was spread out over 7, and this was spread out over 15. When we apply bonus, we get 100% of these numbers all in the first year. And look what it does to our year one deduction.
Wow.
We're now getting a $422,000 deduction. And if you can utilize that at a 35% tax bracket, that creates $162,000 in tax savings.
That's just crazy.
Right? And so you'll see that, yeah, in year 2, we're only getting 23,000 versus 33,000. That's fine. I just saved 162,000 on taxes and went and bought a new duplex.
Yeah.
So that's what bonus depreciation looks like, 100% bonus. Now, if this same property was placed in service in 2023 and we only got 80% bonus, these numbers right here, you would get 80% of these in the first year. The other 20% plays out over the next 4 years, 6 years, and 14 years. So you're still getting a huge bump in year 1, 80%, but you're not getting 100% as you did back in 2022.
Right. Yeah, I saw a lot of real estate investors trying to hurry to purchase before the end of 2022, but 80%
Right.
is pretty solid.
Oh, 80%, 60%, 40% is still very solid because remember, we were doing cost segregation before there was any bonus at all. We're still moving stuff from 39 years to 5 years. But now with bonus, you're saying I can move it from 39 to 5 and get another bump on the first year. Creates massive deductions and really can increase cash flow for investors. So that's kind of how, whoops, let me close out of that. That's kind of how bonus depreciation works. So let's talk a little bit now about catch-up depreciation. So catch-up depreciation, as I mentioned, is just when you've already had a property on the book. So let's say I bought a property in 17, been depreciating it over the last 5 years, just taking my standard straight line deduction. I find myself with a tax liability here in 2023. I can actually do a cost seg study on that property. Even though I've been taking my straight line depreciation, I don't have to go back and amend any prior years, and I get to bring forward all that missed depreciation. And that's called a catch-up benefit, or the technical term is a 481A adjustment. It does require you to fill out an extra sheet to the IRS called the 3115. On that form, we're just telling them, hey, IRS, I was depreciating my carpet over 39 years. I should have been depreciating it over 5 years. So my bad, here's the adjusted amount, and you get to take that current amount on your current tax return. So this is that same bike shop. A little different example here. This is actually a page from one of our reports, but I'll just show you the numbers here. You'll see that on that same bike shop, now we're saying we placed it into service back in 2015. Across the bottom, we still have the $1.3 million of building. You'll see that when we did the cost seg study of that 1.35, from 2015 to the current year of 2022, we were eligible to take 437,000 of depreciation down here at the bottom.
Okay.
We only took 218 by using our straight line method. So the difference between the 437 and the 218 happens to be 218 again. So we get to drop this 218 on our current tax return without ever amending. So basically we're saying, hey, IRS, we were eligible to take 437 over the last 5 years. We only took 218. So in order to catch us up, you guys owe us an additional 218.
That's what I like. That's basically speeding up depreciation again.
Yeah, that's all we're doing on an existing property that I've owned for a number of years. So I can't tell you how many times we've ran into clients who go to get their taxes done, find out they owe a huge tax liability. And we're like, hey, do you own any properties? They're like, yeah, but I've owned it for 5-6 years. It's like, well, that's fine. Let's look at it, see if we're able to create this additional $218,000 deduction, because that, at a 35% tax bracket, that's $75,000 of tax savings.
Right.
So even on existing properties, cost segregation definitely can make sense.
And then on your last slide, it looked like you just fill out a form 3115 with the IRS.
Yep.
And do you guys help with that form as well?
We do. That's a great question, Brian. So it's an ugly tax form. If you don't fill them out often, it's a 9-page tax form that your CPA will charge you. I've seen them charge anywhere from $750 to $1,500 for those. That's included as part of our service. So we include that with the report because we do thousands of those every year. So we're pretty efficient at it. So we're able to get those out pretty efficiently. But yeah, that form does need to be submitted with your return if you're doing this look back study, because on that form, it's actually interesting. You're checking a box that says you're going from an impermissible method of depreciation to a permissible method. Basically saying, hey, IRS, we screwed up. We were depreciating our carpet over 39 years. You know it shouldn't be depreciated like that. We know it shouldn't be depreciated like that. So let's fix it. And here's the numbers. Now, if you don't do it, the IRS is never going to come back and say, hey, we owe you an extra $218,000 of depreciation, right? They'd rather keep that money in their pockets till you guys find out about it. But that's essentially what's happening with that 3115 tax form.
Yeah. I like how you basically said that we're going from an incorrect method to a correct method.
Yeah. Yeah, that's all we're doing. There's actually a box that says that. We check it on the 3115. So again, very powerful for investors who have a tax liability but have existing properties. We can still look at those and do cost segregation. So
great.
All right, so let's move on to the sell of an asset now. This is probably the most important thing we'll learn today. Probably one of the least understood strategies when it comes around cost segregation, but we get this question all the time from both investors and CPAs and say, well, isn't this just a timing issue? If I take all this depreciation up front, when I sell the asset, don't I have to pay it back? And let me explain that. So when you sell an asset, there's 2 types of tax you pay upon sale. There's capital gains tax and there's depreciation recapture. And depreciation recapture is calculated based on how much depreciation you've taken. So in saying that, when you front load all your depreciation, the question I get is, hey, when I calculate my recapture tax, because I've taken all that depreciation up front, doesn't that just mean a bigger tax bill upon sale? And the answer is no, and let me explain why that is. So the whole idea behind cost segregation is there's a rate arbitrage between taking your deduction today against your ordinary income. The highest federal ordinary income is 37%. Take that deduction at 37%. If and when you sell the asset, you pay back some of it at a lower rate at a future date and save the spread. So the recapture rate is 25% and the capital gains rate is 20%. So if I'm taking the deduction at 37%, paying it back at 20%, I'm saving that 17% spread. Now, not only am I saving that 17% spread, that would be if I had to pay it all back, but I'm not actually paying it all back. And let me explain how that works. If you buy a building for $1 million today, sell it for $2 million in 5 years, and you go to settle up with the IRS, you're telling them that everything doubled in value. I bought it all for $1 million. I'm selling it all for $2 million, and they're going to charge you tax on that $1 million of gain. What's actually happening, if I've owned it for 5 years, I bought it for $1 million, had a cost segregation study done. They segregated out my carpet, for example. Carpet's a 5-year asset. What's your carpet worth when you go to sell that building in 5 years?
Well, I hope it's not worth more.
It's not worth more. Unfortunately, that's what we pay tax on, though. It's worth zero.
Right.
5-year asset, bought it for $1 million, sold it 5 years later. It's worth zero, has zero book value. You know what happens when you don't do a cost seg? You're saying you bought your carpet for $500. You're now selling it for $1,000. Well, the carpet's dirty and stained. It's 5 years old. You shouldn't be selling your personal property for more than you paid for it 5 years prior. But when you don't do a cost seg study and you can't pull the carpet out, you can't pull the cabinets out, you can't pull the parking lot out, you're selling all those assets for more than you bought it for.
Yep.
It's causing you to pay more tax. So kind of in summary, take your deduction at a high rate, pay back a portion of it, not all of it, a portion of it, depending upon how long you've owned it, at a lower rate and save the spread. And that's all we're doing with cost segregation. So, Bryan, we'll even have people call us right before they're getting ready to sell an asset and say, hey, I've owned this building for 10 years. I'm getting ready to sell it. I'm under contract to sell it. Can you do a cost seg study right before I sell it? And the reason being is they want us to identify the 5, 7, and 15-year assets so that when they sell it, they can allocate their sales price not to the dirty, nasty carpet, but to the building, right? They want to pull the carpet out. They want to pull the cabinets out. And so this is an example. This is that same bike shop. This is probably the most complex we'll get, so just bear with me here. I'll try and keep it as high level as possible. But this is that same bike shop. Trust me here, I don't have the notes here, but bought it for, let me move. Whoops, that's not what I wanted to do. Hold on one second. I got to move this over here so I can see here. All right, so this is that same bike shop. I bought it for 1.3 million. Whoops, let me get my pen here. I bought it for 1.325 million. I sold it 7 years later for 2 million. If I don't do cost segregation, my tax bill on that transaction is 198,000 here at the top. So that's my capital gains and my recapture tax. So of the 675,000 I made on the property, I got to pay Uncle Sam 198,000. Now, when I do a cost seg study, remember we have the same numbers. We've got our $1.3 million of building. We segregated it into 5, 7, and 15-year assets. What are my 5-year assets worth after owning this building for 7 years? They're worth zero right here. They're fully depreciated. My 7-year assets are worth zero. My 15-year assets still have some book value because we've only used up about half of them, right? When all of these numbers flush out, my total tax bill when I sell this building now by doing a cost seg is 164,593. So I just created a $34,000 permanent tax savings. So not only have I had all that money for the last 7 years to pay down debt, to buy new properties, when I go to sell my asset, I actually create a permanent tax savings of 34,000 by doing cost seg. And again, that's just a matter of not selling my dirty, nasty carpet for more than I bought it for. And that rate arbitrage of taking your deduction at a high rate, paying it back at a lower rate, and saving the spread. So if you guys remember anything from this slide, don't sell your dirty, nasty carpet for more than you bought it for, right?
There you go. That's the best way to say it. So I bet you get a lot of, I wish I would have known this before I sold my property.
Right. Yeah, we do get a lot of that. So, so one of the more advanced concepts that we'll go over, but again, if you remember anything, just don't sell your carpet for more than you bought it for. And always have an analysis run, because it may be worth doing a cost seg study even right before you sell. You know, a cost seg study on this bike shop probably cost you $4,000. But if I can create a $34,000 tax savings, I just cleared $30,000 in tax savings. So definitely worth looking into.
Yeah, I love it. We're always looking for tax savings for our clients. So that's a big way to save some taxes.
Absolutely. All right. So this slide here, this is just kind of a summary of the 4 different case studies, all on the same building, but in different scenarios. And we were able to save anywhere from $15,000 in tax savings on our first study here, $162,000 when we applied bonus. When we did the look back study, we were able to save $88,000. And then even when we did the study right before we sold the asset, we still were able to save $34,000. So you can see that it's not a matter of if I should do cost seg, it's a matter of when. And we want to use it when we can maximize the deduction. And that's different based on each investor, based on their income, their tax bracket, their investment strategy, if they're going to hold it, if they're going to sell it. And so always get the analysis done up front so that you have that in your back pocket and can utilize that in your tax planning. So just wanted to give you an example there of how that same building in 4 different scenarios, we were able to create tax savings. So,
No, that's perfect.
all right, let's just touch quickly on partial asset dispositions, then we'll wrap up here with the audit guide. One of the side benefits of doing cost segregation is something called partial asset disposition. So a partial asset disposition is when you dispose of part of your building, the IRS allows you to write off the remaining book value in the year of disposition and write that off as an expense, and you never have to recapture that. So I'll give you an example of where we see this most often is we'll see a depreciation schedule that says building, and then underneath that it says land. So they're depreciating the whole building just as one big lump asset. They didn't do a cost seg study, one big asset. 2 years after they buy the building, they have to replace the roof. And so then there's another line item on the depreciation schedule with a new in-service date of 2 years later that says roof, $100,000. When we see that, what's happening is we're depreciating 2 roofs at the same time. You've got the first roof that's stuck in that big building, that's getting depreciated. Then you've got the new roof that's getting depreciated. And now we're depreciating these at the same time. Well, the original roof was disposed of. We ripped it off, we threw it away. Whatever the book value of that roof was when you disposed of it, let's say that it was had $40,000 left of value on the books. You could take that $40,000 and write it off as an expense and never pay recapture on that. And so that's hard to do when you just have building on your depreciation schedule. It's hard for CPAs to figure out what the roof was worth or what the parking lot was worth. When you have a cost seg study and you have everything lined up, it's very easy when you go put in a new parking lot or you replace the roof or put in new flooring for your CPA to pull that old asset off the books, write it off, create an expense that you don't ever have to pay recapture on. And so just one of the side benefits of doing cost segregation is the ability to take these partial asset dispositions. All right, 2 slides left. Again, probably my most exciting slides because I'm kind of a cost segregation nerd. Probably the least exciting for your listeners, so I'll go through them pretty quickly. The IRS issues an audit guide that tells their agents how to review these cost seg studies. There hadn't been any changes to the audit guide since 2007, any major changes, I should say, since 2007. So at the end of last year, the IRS came out with a new audit guide. And the reason for that is cost segregation has kind of been the Wild West. There's no governing body. There's all kinds of different methodologies on how to do cost segregation. And the IRS is saying, hey, we got to standardize some of these processes and make it even across the board. So they came up with the new audit guide, or revised the audit guide. And I just wanted to read this quote. This is directly from the audit guide, but it says the underlying incentive for preparing these studies is for federal tax purposes, or I misread that. The underlying incentive for preparing these studies for federal income tax purposes is a significant tax benefit derived from using shorter recovery periods, such as accelerated depreciation methods and bonus depreciation. So the reason I have this here is the IRS is aware investors are doing this. Bonus depreciation made this way more popular, way more available for your smaller investors. So the IRS is saying, hey, agents, it's okay that they're doing this. We just need to make sure they're doing it the correct way. Now, the correct way, this is my favorite slide of the whole presentation. Again, directly from the audit guide, these are the 6 preferred methods to do cost segregation. Number 1 is a detailed engineering approach from actual costs. So that's pretty straightforward. You build a brand new building, you have a list of actual costs, you give it to your cost seg provider, they segregate it, split it up, give it back, pretty straightforward. Number 2 is a detailed engineering cost estimate approach. This would be you buy an existing building built in 1980. You don't have all the costs of what the parking lot costs, what the flooring costs. So a cost seg company comes in, does some modeling, puts a value to those different components, pretty straightforward. Let's skip down to number 6, rule of thumb approach. An examiner should view this approach with caution since it lacks sufficient documentation to support the allocation of project costs. My question to you, Bryan, you've worked with the IRS, is number 6 a preferred method or is it not? Because it's listed under the preferred methods, but then it says this method sucks, don't do it this way.
Yeah, I wouldn't do anything by rule of thumb when it comes to a cost segregation study.
Right. So the reason that's in there, and you alluded to this earlier in our conversation, there are software out there. There is some CPAs trying to do this themselves. I actually tell you a quick story. On a call with a CPA, he said, my client had a casual cost segregation study done. I'm thinking, casual cost segregation, I've never heard that term. I don't know what you're referring to.
Right.
He sent me the depreciation schedule. It was actually a client that he had inherited from a previous CPA. So it wasn't him, thank goodness. But on the depreciation schedule, it said apartment building, $1 million, appliances, 40,000, parking lot, 60,000. The CPA had just gone through and cherry picked some of the easy categories and put these big round numbers. And I'm like, if you're trying to fool somebody, at least don't use 60,000, do like 60,104 or something, right?
Right, no round numbers.
Yeah, red flag for the IRS. But anyways, they had just rule of thumb and said, well, I think the parking lot's probably worth 60,000. 2 things. One is if this ever gets audited, they're throwing the whole report out because there's no methodology on how they came up with those numbers. Number 2, had the client paid for an actual cost seg study, we would have got significantly more benefit that would have way outweighed the cost of the study in terms of tax savings. So I wanted to bring this slide up. There's softwares out there. If your CPA tries to do this himself, that's a red flag. Pay to have a study done. The amount that you're going to pay for the study, you're going to save 10x that in return on having an actual study done. So we typically segregate somewhere around 30%. The softwares and CPAs that do it themselves, somewhere between, I've seen as low as 12% and as high as 18%. So that additional 12% on $1 million building is 120,000 of depreciation. At a 30% tax bracket, that's a $40,000 tax savings. So pay the extra $3,000 to get the study done so you can save 40 additional. You'll come out way ahead. So
yeah, you just gave us a couple of great examples of different ways, partial asset dispositions and
oh yeah,
and all that.
absolutely.
So you're gonna find more money in tax savings than it's gonna cost you to do it yourself.
Every time. So last slide here. This is just the 9 quality elements of a cost seg study. I just want to direct your attention to number 3. I've been doing this for 7 years. I would say 80% of the reports up to this date don't include number 3, which is a schedule of assets. So this says when a taxpayer reallocates the costs of assets already on the books, a quality report identifies those specific assets impacted and includes depreciation from before and after the reallocation. So this goes back to that look back study in that form 3115. A lot of the reports won't reconcile how much depreciation you had already taken on your carpet versus how much you're eligible for. They leave that up to the CPA, which can be very, one, time consuming and cumbersome. And so this is good news for you guys in the CPA world that we should start seeing more reports include this schedule of assets because the IRS is listing it as part of their quality study, one of the elements of a quality study. So again, the online, you're not going to get that. But something that's important, something that'll make the lives of your CPAs much easier. I just wanted to point that out. Make sure if you're getting a study done that they are including that 3115 tax form as well as that 481A adjustment, because that's, according to the IRS, that's part of a quality study. If it doesn't have that and you're leaving it up to your CPA to figure that out, it's not technically a quality study according to the IRS. So with that, just some things to think about. Any revenue generating property is eligible for cost segregation. So if you've got, even if you've got a basement apartment, sometimes I've seen those pencil out where it makes sense. Maybe you bought it for $500,000, which, you know, you're renting out half of it. So it's got a $250,000 basis. If we can create a $75,000 tax savings, it's probably worth doing the study if you can absorb that deduction. So any revenue generating property. Number 2, always have a benefit analysis done. So most cost save companies will provide a free analysis for you and your CPA. That analysis will give you a conservative idea of what you can expect in terms of tax savings, as well as what the fee would be. And then you guys can decide if it makes sense to go forward from there. Cost seg studies range anywhere from $3,000 for short-term, single family homes, to, $50,000 to $100,000 for large ski resorts that have multiple lodges. So I know that's a wide range. Most studies come in somewhere between 5,000 or 6,000, but you're going to save tenfold, especially with bonus depreciation in terms of tax savings. We want to see you save at a minimum tenfold. So if we're charging you 5 for a study, we're hoping that you're seeing a $50,000 return on that investment. So at a minimum.
And that's what's great is someone's going to see the cost benefit first. So it's not like they go write you a check and they don't know any numbers right off the bat, going into it blind. They're going into it with full upfront disclosures and all that.
Yeah, and that's why we like to get the CPA involved early. We know a little bit, we'll get on the call with an investor. They're like, oh, I bought it for this. I've had it for this long. Well, I may say, hey, let's do a cost seg study. But once I talk to the CPA, I might find out that you've got a carry loss or a loss carry forward from a prior year. And so you don't need any additional deductions this year. And so maybe you just hold the cost seg study in your pocket till next year, do the study next year when you've run out of your losses that you've been carrying forward. So we always like to get the CPA involved early. We don't ever want to engage somebody unless they're going to save significant tax dollars. And so that's why we run those analysis and get the CPA involved to say, hey, we're all on the same page. We think you're going to be able to save money. CPA, do you agree? Yeah, I've run some preliminary numbers and it's definitely going to save tax dollars. At which point you engage us. We come out, do the site visit, and then usually a couple of weeks after the site visit, takes 2 to 3 weeks, we'll provide you and your CPA a 40 to 60 page report, has all the backup documentation, the tax paperwork that's needed for you to realize these deductions. So
yeah, that's one thing that's super important to us right now is there's been the talk of the IRS hiring more and more auditors. And so
right.
to hire more and more auditors, it's best to have your ducks in a row, have all the documentation, have it all to where you can provide it to the IRS and feel safe that it's done correctly.
Absolutely. Yeah.
And that's the other thing I like, kind of going back to what you just said, is I had a client that emailed me this week, just put down basic numbers, here's my purchase price, how much is it going to save me in taxes?
Right.
Like without knowing, what the property is, what year it was, all the extra information, it's hard to just come up with a number out of the sky.
Yeah. No, definitely have the analysis run. We do it free. Usually takes about 24 to 48 hours for us to produce those analyses. And then once you have that, you can share it with your CPA and determine again if this is the right year to implement that strategy. So
Okay.
that's all I've got, Brian. So
Yeah.
here's our contact information. Nico is one of my colleagues. I travel a lot and speak on the road. And so Nico's the best way to get a hold of us. His name is there, his email, his contact information. Feel free to give Nico a call. Go to our website. My contact information's on our website. If you guys ever have any questions, please use us as a resource. We don't bill by the hour. We're not a CPA firm. If you have any, well, we are a CPA firm, but a niche CPA firm, and where we don't actually do tax returns. But if you have any questions specific to real estate tax or depreciation, don't hesitate to reach out. Earn business income, child tax credits, call Bryan. Anything depreciation, feel free to call us. We're happy to help. I think the weirdest question we've ever been asked is how to depreciate mule deer at a breeding facility in Wisconsin. So I actually didn't know the answer, but I was able to get with my team, find the answer. But we'd love to be a resource and work with you guys, you investors who have properties. Love to help save money in any way possible. So
It sounds like you guys are pretty much nationwide right now.
We are, yeah. So we do studies in all 50 states. Absolutely. So no matter where your property is, where we can get there, we've got virtual site visits that we can do. So give us a call. We're happy to run you an analysis.
I love it. Well, thanks so much, Eric, for your time. I know that you could go on, probably for hours going into more detail with all this and all the other things that you guys can help with. But this is going to be great value for those that go and watch the webinar. So I appreciate it.
Sounds good. Thanks, Bryan.
Okay. All right. We'll see you later.
Take care.
Okay. Bye, Eric.
Bye-bye.